Welcome to Finance Made Easy. Not long ago, Federal Reserve Chairman Janet Yellen subtly hinted that the U.S. might raise interest rates. The next day, the U.S. stock market dropped significantly, and global markets followed suit. Did you notice that even Tencent stock fell by several dollars? Yesterday, I mentioned that these phenomena are driven by one of the most fundamental principles of modern economic operation. The government controls the scale of credit and regulates the economic climate through the banking system. Among the key tools for this regulation are the reserve requirement ratio and the benchmark interest rate. Why are these important? The reserve requirement controls the amount of money, while the benchmark interest rate adjusts the price of money. By controlling both quantity and price, the government can regulate the credit scale and the overall economic conditions. Yesterday, we talked about the credit expansion mechanism of the reserve requirement. Today, let's dive into the benchmark interest rate. First, let's understand what the benchmark interest rate is. The benchmark interest rate is essentially a reference point for the overall interest rate level in the market. Financial institutions use it as a standard to determine their own loan and deposit rates. When the central bank raises or lowers the benchmark interest rate, it means the entire society's interest rate level is being adjusted. To illustrate, think of the banking system as a huge irrigation system, with money flowing like water. What does the benchmark interest rate represent? The benchmark interest rate is like the price of water. If the price of water increases, it becomes too expensive to irrigate the fields, and farmers may prefer to leave their land fallow rather than cultivate it. On the other hand, if the price of water is low, farmers may be more inclined to open up new land and plant more crops. Similarly, by adjusting the benchmark interest rate, the government controls the price of money, which in turn influences people's willingness to invest and consume. Generally, when the government is concerned about an overheating economy, it raises interest rates, i.e., it tightens the money supply. For instance, in 2010, after China implemented a 4 trillion yuan stimulus, the economy showed signs of overheating, and the central bank raised interest rates several times to cool things down, gradually applying the brakes. However, finding the right balance and pace for raising interest rates is very difficult. If the rates are raised too quickly, it could lead to excessive tightening and cause severe economic fluctuations. China has had lessons from the past in this regard. In 1994, China sharply raised the benchmark interest rate, which led to a serious economic hard landing. Those familiar with history may remember that after Deng Xiaoping's southern tour in 1992, the economy rapidly surged, and many investment projects were launched, quickly leading to signs of overheating. The most severe case was in 1994, when inflation reached 24%, nearing hyperinflation levels. Rice prices even doubled that year, and with relatively low wages, people became anxious. Those a bit older might remember that people rushed to exchange foreign currency and hoard goods, clearing out rice and vegetable oil from the markets. Because inflation hurt the public so severely, it risked causing social unrest. The Chinese government decided to take decisive action. At that time, the central bank governor was the tough and decisive Zhu Rongji, who began implementing aggressive tightening policies. Soon, the central bank introduced more than a dozen measures to curb credit growth, the most important of which was raising loan interest rates. From 1993 to 1995, the benchmark loan interest rate in China increased from 8% to 13.5%, a 70% rise. While raising interest rates to control overheating was the right approach, such a rapid and forceful increase led to unintended negative consequences. We talked yesterday about how the banking system is like a massive irrigation project, with commercial banks acting as various water stations along the way. The system has a credit expansion leverage effect. Now, the central bank has suddenly turned off the faucet by raising the benchmark interest rate. But what has it overlooked? T has overlooked the fact that the leverage effect of the commercial banking system could amplify the tightening effects many times over. Sure enough, the economic slowdown turned out to be much stronger than Premier Zhu Rongji had anticipated. First, businesses were unwilling to take out loans, and construction projects came to a halt. Those that had already started, companies preferred to abandon them and let them become ghost buildings rather than continue. On the other hand, banks were also hesitant to lend. Why? With interest rates so high, they couldn't be sure of recovering their loans. If the loans weren't repaid, both the bank president and the loan officers would be held accountable. So, no new projects were launched, and there was little willingness to lend. In less than 2 years, construction sites across the country that had been overheated turned into a pile of unfinished buildings. If you visit Hainan today, you'll still see many of these incomplete ghost building projects from that time. Another interesting example is the famous entrepreneur Shi Yuzhu, the founder of the Brain Platinum brand. Back then, he was ambitiously building the giant tower. But when the banks raised interest rates and started withdrawing loans, he found himself unable to borrow money. The giant tower became one of the most notorious unfinished buildings of that era, and Shi Yuzhu eventually declared bankruptcy. It wasn't until more than a decade later that he made a comeback with giant gains. But the more serious issue was this: many loans had been extended in the previous years, and now, with the interest rates increased, many companies went bankrupt. These bankrupt companies all became bad debts, and where did they end up? On the bank's balance sheets. The Chinese banking sector was in great trouble, with the bad debt ratio of the big four banks reaching as high as 40%, bringing them to the brink of collapse. It was NT until 1998 and 1999 that China's economy finally began to recover from the shadow of that regulatory tightening. During that time, the China collapse theory was particularly popular, and it was largely related to this economic hard landing. So, we can say that while raising interest rates can be used to cool down an overheating economy, going too far can lead to water becoming too scarce, causing a severe economic drought. Similarly, lowering interest rates can stimulate the economy. China provides a good example of this, as in 2014 and 2015, the government's macroeconomic control was relatively tight, leading to an overly cold economy. In response, the central bank started cutting interest rates. Thanks to these cuts, in the second half of 2016, many places felt the economy improving, and there was a brief economic recovery, or spring. However, just like with raising interest rates, it's difficult to find the right balance when cutting rates. If done excessively, it can lead to flooding the market with too much water, which results in rampant asset bubbles. Take, for example, the well-known U.S. subprime mortgage crisis in 2008. This was essentially an asset bubble event driven by a policy of lowering interest rates. Here's how it happened. Around 2001, the U.S. experienced a tech bubble followed by the 9/11 terrorist attacks, causing the economy to enter a recession. To stimulate the economy, the Federal Reserve began lowering interest rates, cutting the federal benchmark rate 11 times in a row. By 2004, the benchmark rate had dropped to below zero, meaning negative interest rates. What does negative interest mean? It means that borrowing money actually becomes profitable. This caused an immediate surge in people's willingness to borrow and invest. At the same time, the Bush administration loosened conditions for mortgage loans, so many people who had no ability to repay were also able to borrow to buy houses. As a result, real estate prices started climbing rapidly, breaking historical records. On the other hand, because these loans were taken by people who couldn't repay them, the quality of these real estate loans deteriorated, leading to what we now call subprime loans. These toxic loans were then repackaged by the greedy Wall Street financial sector in flashy ways, heavily leveraged, and sold all over the world, inflating the bubble until it finally burst. Many people argue that the overly aggressive interest rate cuts were a major cause of the U.S. asset bubble. Another familiar example is Japan. Everyone knows about Japan as a real estate bubble in the 1990s and the lost 2 decades that followed. But what many got to know is that the bubble was also a result of interest rate cuts. In 1985, the US, Japan, the UK, France, and Germany signed the Plaza Accord, which aimed to devalue the dollar and appreciate the yen. As the dollar weakened and the yen strengthened, Japan's exports suffered greatly, leading to an economic downturn. To boost the economy, the Bank of Japan also adopted its usual approach, cutting interest rates. Within a year, the benchmark rate was reduced from 5% to 2.5%, halving it. At that time, a 2.5% interest rate was very low. This ultra-low borrowing rate stimulated investment and consumption, increasing both household and corporate leverage. Japanese real estate prices began to rise rapidly. By 1989, Japanese real estate prices reached astonishing levels. For example, in Tokyo's upscale Ginza district, commercial real estate was priced at more than 3 million RMB per square meter. The land price under Tokyo's Imperial Plaza was equivalent to the total land value of California. We all know what happened next. As with all bubbles, it eventually burst. Japan's real estate bubble collapsed between 1990 and 1991, spreading from Tokyo to other cities. Japan's economy slid into a deep recession. Businesses went bankrupt, residents faced widespread insolvency, and many banks were dragged under, going bankrupt themselves. If you look at both the US and Japan, you'll all find that their asset bubbles were closely linked to overly aggressive interest rate cuts intended to stimulate the economy. As we mentioned earlier, lowering interest rates can stimulate the economy, but if done carelessly, it can flood the market with excess liquidity and lead to rampant asset bubbles. This is Finance Made Easy, helping you gain a higher perspective and re-understand wealth.